So one of the things that we wanted to do here was to cover as much of the landscape as we could from an investment perspective. And I mentioned in the early part of the conversation that Impax actually manages two different streams of activity. We manage a series of listed equity or public equity funds. And we also manage direct project finance activities. Those funds invest exclusively in renewable energy project finance. So it's a very clean, direct impact kind of activity. New green kilowatt hours are being created, can be measured and tracked over time. It's clear that there are opportunities there, and I think the point that I'd like to make in both regards, I've worked on both sides of the house, private equity and public equity. I know from my experience that those companies that are active and successful in managing private equity investments, project-like investments, infrastructure investments in the clean energy arena are producing results which match those from the standard range of investments in those classes of infrastructure categories. So there isn't any reason, I can't prove this to you statistically, but there's no reason from my experience to assume that you should expect a lower return if your manager is good at what he's supposed to be doing. On the listed equity side, it's a little easier to track. We actually can look at public information and indices. And we did some research now 2 years ago, just looking back over 5 years at what would have happened to an investment portfolio which didn't hold fossil fuel stocks, otherwise undifferentiated. So take an index, back out MSCI World in this case, back out the fossil holdings, look at what happened to the performance. Turns out over a 5-year period, nothing happened to the performance. In fact, the fossil-free version slightly outperformed. So we had people quickly point out to it, and we wrote a little paper, which we'll have some copies of, I guess, and people quickly point out, but it's 5 years, too short, and that's a fair point. And then somebody else said, yes, and it's been a lousy 5 years for fossil fuel companies. That was also true, still is true, but that's okay. And so we said, that's fair. We're not a research house. We can't do a longer analysis. Fortunately, MSCI is a research house. They quickly came up with a report looking back over 7 years, same conclusion. They then did a report for CalSTRS looking back over 10 years, same conclusion, no difference, effective difference in the portfolio. Apereo does a review of risk parameters, effectively no difference in the risk parameters of this portfolio. And then a private investment advisory firm which has no connection to the green industry or sustainable investment in any form, Advisor Partners in Walnut Grove, California, did the longest study that I've seen, goes back over 22 years, reconstruction of the portfolio, ex-fossil fuel, and their summary report said that there was effectively no difference in return over a 22-year period. You can certainly make a lot of money if you buy in and sell fossil fuel holdings, as you can in any other sector, in water, in utilities, in renewables, but the standard assumption for most managers I knew was you bought you bought fossil holdings, you held them, you may trade them around, but you held that position in your portfolio, and the assumption was that was critical to your return. There have been about a dozen studies done so far. So far, none has substantiated that they were in fact critical to return. So interesting questions about how else you rebalance your portfolio, but I guess I could say from the outset that you should not assume that you're going to give up return in your listed equity portfolio either. So let's now look at the debt side, fixed income side. So Benji, if you're looking at a situation where you're offering your clients green bonds, should they expect to see a lower return, the same return, or a better return for those bonds in your portfolio?
So we generally feel like if you're looking at the appropriate sector and rating and comparing a green bond to any other bond, that you shouldn't see a difference between the performance of the green bond versus what you'd expect from a normal corporate or something like that with a similar rating. The trading that we've seen that goes on, someone had mentioned about, kind of the lack of liquidity. And someone mentioned too kind of about it's really more the lack of an offering than it is the lack of a bid, because generally the bid-ask spread on a green corporate bond, and the few that are out there, is pretty darn similar to the other bonds necessarily. But what you do see is if you wanted to go in and buy 100 or a 500 piece, 500,000 piece or something like that, you might not be able to get an offer for it because literally, we rarely sell bonds, and most other people are buying them and then putting them away. So there just hasn't been necessarily enough issuance in those. So, I think if you're looking at it kind of sector and rating specific, I think that you shouldn't necessarily see a difference between green bonds and other bonds, and especially the biggest spot where we would be playing in kind of that super sovereign space where There's been the most green bond issuance. I mean, the issuance is essentially the same in terms of the issue spread. You know, there's generally a new issue concession, and they're normally a little bit oversubscribed. And so generally it seems like you shouldn't have much of an issue there. I mean, my main point is kind of, if you're talking about a big, broad portfolio, there's still certain sectors that, I mean, that are still a little shy in terms of true broad diversification.
Right, and value nodding, is that your experience too from looking at the market?
Yes, yeah. Well, I think as Benji said, there is not a lot of data to work with at this point, but there is definitely analysis of the super sovereign issuances and the green bonds. Looking at secondary trading and pricing, the green bonds tend to price at just about the same and have the same performance as the bond that supranational would have otherwise issued. I mean, we never hear discussions about whether green bonds would underperform a regular bond that's issued by that corporate or by that super sovereign. We more talk about whether there will eventually be a pricing differential, because as Benji noted, the green bond issuances are certainly really popular. They bring different investors to the table than you would normally see for that corporate or sovereign, and they're oversubscribed. They sell out very fast, and and by the way, at greater cost to the issuer. So because of the additional accounting requirements, because of the transparency requirements, there is additional cost to the issuer of the bond. And the issuers of the bonds do it because it has interesting reputational benefits. It engages them with new investors that they didn't currently have relationships with, so there's a benefit to them. But I think the question that we hear is not about performance. That's assumed to be at least as good. The question that we hear is about whether at some point in the future pricing will change to reflect the fact that there's greater demand.
And one other thing too on that, I mean, so KBN, they just recently did a 10-year bond, and that was a $500 million deal. But before that, near the end of last year, some of the largest U.S. dollar bonds, KFW brought a $1.5 billion bond, and EIB brought a $1 billion bond. When you're talking about sizes like that, I mean, obviously they're well in the index, they're going to be readily tradable. I mean, which, you know, when the market was first starting, you know, in IBRD, the International Bank for Reconstruction and Development, part of the World Bank Group, when they were first just starting to bring these, I mean, yeah, then they were kind of in the 10, 15, $20 million size, but we're in a whole, and some of those still occur, and on the retail side, those are still possible for people to get. But when you're talking about liquid bonds, I mean, green bonds, you know, when you're in the 500 million to obviously, you know, $1 billion to $1.5 billion, you're in a very liquid size for the market, so.